Across global financial markets, investors constantly seek to navigate volatility for potential returns. A recent surge in commodity prices driven by a complex mix of supply chain disruptions, shifting monetary policies, and renewed industrial activity has once again brought precious metals into the spotlight. While both gold and silver are often grouped together, the speculative activities surrounding them are fundamentally distinct. Understanding these differences is not just an academic exercise. It is crucial for grasping the risk appetites, capital flows, and market structures that define this critical sector. This brings us to a foundational question. What are the core structural differences between speculating on silver versus gold? The practice of speculating on silver and gold involves attempting to profit from short-term price movements. But the nature, risks, and strategic approaches for each metal diverge significantly. These distinctions are not arbitrary. They are rooted in the unique physical properties, market structures, and induces of each metal. For policymakers monitoring economic stability, institutional investors managing portfolio risk, and traders executing strategies, comprehending these differences is paramount. Gold speculation often centers on its well-established function as a safe haven asset, a hedge against systemic risk during periods of economic turmoil or high inflation. Conversely, silver speculation is more dynamic, reacting with greater intensity to shifts in both macroeconomic indicators and, crucially, industrial demand. The strategic calculus for each metal is therefore shaped by a different set of incentives and institutional behaviors, leading to distinct patterns of capital flow and risk transfer within the global financial system. The core of silver speculation is defined by its pronounced volatility. Silver prices are known to exhibit wider and more rapid fluctuations compared to gold. This high beta characteristic creates a dual reality for speculators. It offers the potential for substantial short-term profits, but it also exposes them to a correspondingly higher risk of significant losses. This volatility is not random. It is a direct function of silver's dual identity as both a precious metal and an essential industrial commodity. Unlike gold, whose industrial applications are relatively limited, silver is a critical input for a growing number of key industries. It is indispensable in the production of green technologies, including photovoltaic cells for solar panels and components for electric vehicles. Its superior conductivity makes it vital for electronics, and its antimicrobial properties secure its role in healthcare and water purification. Consequently, the demand side of the silver equation is heavily influenced by the health of the global industrial sector. A surge in manufacturing output or a technological breakthrough in a silver-dependent industry can trigger a rapid increase in its price, independent of broader financial market sentiment. This direct link to the real economy means that speculators in the silver market must pay exceptionally close attention to industrial production indices, corporate earnings reports from key sectors, and technological trends. The structural dynamics of the silver market further amplify its inherent volatility. The global silver market is considerably smaller in scale than the gold market, which translates into lower overall liquidity. In a less liquid market, even moderately sized transactions can have a disproportionate impact on prices, making the market more susceptible to sharp short-term swings driven by shifts in supply and demand. This lower liquidity also means that executing large trades without moving the price can be more challenging compared to the deeper gold market. Furthermore, the derivatives markets for silver, such as futures and options, often provide higher degrees of leverage. This allows speculators to control a large nominal position with a relatively small amount of capital. While leverage can magnify potential profits, it is a double-edged sword that equally amplifies potential losses, making high-leverage silver speculation an inherently riskier endeavor. Given these conditions, the strategies employed by silver speculators are often tactical and short-term oriented. Many rely heavily on technical analysis, charting price patterns, and using indicators to predict future movements. They also react swiftly to breaking news, whether it's an economic data release or a report on industrial inventories. Strategies like dip buying on price pullbacks in anticipation of a rebound or short selling on price spikes are common tactics designed to capitalize on the metal's frequent and sharp price oscillations. In stark contrast, Speculation in the gold market operates under a different set of principles, primarily dictated by its long-standing role as a safe haven asset. For centuries, gold has been the asset of choice during times of profound economic instability. Currency devaluation, high inflation, and geopolitical conflict. When confidence in governments, financial institutions, or fiat currencies wanes, capital historically flows into gold as a store of value. This institutionalized belief in gold's stability helps to anchor its price, making it generally less volatile than silver. While gold is not immune to short-term price fluctuations, its value is less influenced by the cyclical demands of industry. Its primary function within the global financial system is not as a raw material for production, but as a monetary asset and a final backstop against systemic risk. This safe haven status provides a structural floor for its value, lending it a degree of stability that silver, with its industrial ties, lacks. The gold market's price movements are therefore more closely tethered to the macroeconomic and geopolitical landscape. Factors such as changes in central bank monetary policy, real interest rates, inflation expectations, and the strength of the United States dollar are primary drivers. For instance, a policy of monetary easing or falling real interest rates typically reduces the opportunity cost of holding a non-yielding asset like gold, making it more attractive to investors and speculators. The institutional framework of the gold market reinforces its stability. It is one of the largest and most liquid financial markets in the world, with deep pools of capital from central banks, institutional investors, and individual savers. This high liquidity ensures that market participants can buy and sell large quantities of gold with relative ease and minimal price impact, which helps to dampen extreme volatility. Consequently, while short-term speculation certainly occurs, gold is often viewed as a lower-risk proposition for long-term capital preservation. Speculative strategies in the gold market, therefore, tend to be more grounded in fundamental analysis. Speculators focus on interpreting macroeconomic data and geopolitical developments to forecast shifts in investor sentiment and capital flows. A trader might take a long position in gold in anticipation of an inflationary cycle or in response to escalating international tensions, aiming to profit from the predictable flight to safety that such events often trigger. The strategic focus is less on capturing rapid intraday price swings and more on correctly positioning for broader secular trends, driven by systemic factors. To illustrate how these systems operate under real-world conditions, consider a plausible market reaction pattern following a surprise announcement of aggressive monetary tightening by a major central bank, such as the United States Federal Reserve. The central bank signals its intent to raise interest rates more quickly and steeply than the market had anticipated in order to combat rising inflation. In the immediate aftermath, yields on government bonds would likely surge, increasing the opportunity cost of holding non-yielding assets. In this scenario, the gold price would almost certainly face immediate downward pressure. Speculators who had been long gold as an inflation hedge would see their thesis challenged by the central bank's decisive action. The allure of higher yields on less risky assets like government bonds would pull capital away from gold, leading to a wave of selling. Long-term investors might hold their positions, but short-term speculators would likely liquidate, amplifying the initial price drop. Simultaneously, the silver market would experience a more complex and potentially more violent reaction. Like gold, silver would suffer from the higher opportunity cost and a stronger United States dollar, which typically moves inversely to commodity prices. This would exert significant downward pressure. However, the industrial component of silver's identity would introduce a second conflicting variable. The central bank's aggressive tightening is aimed at cooling an overheating economy, which implies a future slowdown in industrial activity and manufacturing output. Speculators in the silver market would immediately begin to price in a drop in future industrial demand from sectors like electronics and solar energy. This expectation would create a powerful secondary wave of selling, compounding the initial drop caused by monetary factors. Because the silver market is smaller and less liquid, and because many positions are held with high leverage, this cascade of selling could trigger margin calls and force liquidations, leading to a much sharper and more severe price collapse than what is observed in the gold market. In this scenario, while both metals would decline, silver's price would fall further and faster, demonstrating its higher sensitivity to both financial conditions and economic growth expectations. Clear manifestation of its dual nature, risk profile,